Welcome to Tradespoon. My name is Vlad Karpel. I'm CEO and founder of Tradespoon, and today we're going to have our weekly strategy roundtable discussion where we talk about current market condition, interest rates, equities, treasuries, what are the opportunities in the market, which sectors, which stocks can outperform the market in the short term and long term. For those of you who are new, welcome. If this is your first live event, do me a favor, type in first. Always want to welcome new subscribers. For those of you who are returning subscribers, welcome back. Really appreciate your time. If you're new, please type in first or type in hello. First of all, Happy New Year to everybody. I hope all the bad things will stay in 23, all the good things will move to 24. It'll be a healthy, peaceful and prosperous new year. So to everybody. Disclosures are very important. Please read them. I'm going to go through specific trade ideas. So it's very important to understand the disclosures. If you're new to trading stock or options, I encourage you to visit optionstraining.com so you can understand the risk associated with trading stock and options. I'm not a financial advisor. I'm not registered with FINRA nor SEC. I'm showing you what I do in my own account based on my own risk tolerance level. For general education information purposes only, please consult your financial advisor prior to making any trading decisions. All right, let's talk about 23 before we talk about trading plan and just overall. I mean, I know some of you have been on my webinars, but still, let's just sum up 2023, right? In December of 2023, I was pretty bearish actually on the market, right? I thought, let's look at spiders, that we will have a recession, right? That the Fed will not lower interest rates, right? That the oil is going to drop, commodity is going to drop, and we will break through the October lows. That was, or at least revisit October lows, but I actually thought we were going to break them last year. So what was different? I mean, the main difference, we did have a pretty significant pullback in March, was the liquidity issues in regional banks. And then in June, we have this wave of generative AI, with the idea that artificial intelligence is going to significantly increase the revenue of a lot of S&P 500 companies, right? We had this big breakout to almost 460, right? I was pretty bearish in June. And then we did have a 10% drop in July, August, which kind of predicted correctly that we will have a strong rally. A lot of it based on seasonality. So from seasonality point of view, that's correct. So was wrong on interest rates, right? I thought the interest rate will actually be stable and slightly lower. They were not. We had a big jump, higher for longer narrative. And the generative AI, right? So this year, obviously, I'm less bearish because the probability of deep recession is a lot less, or actually any recession right now has significantly decreased. I thought there would be an uptick on unemployment. We haven't had an uptick on unemployment, and revenue has been more significant, better than anticipated. We started 2023 also with very bearish sentiment, right? Not only I was bearish, majority of the people were bearish, right? So any positive surprises like generative AI or better than expected earnings and unemployment being steady, you have very positive surprise and move to the upside. We're starting 24 kind of in the opposite way, right? S&P multiple is, extremely elevated, right? I think it's S&P multiple is 22, average is 17. Interest rates, Fed is already said that they're going to hold, and they're penciled in, at least 3 rate cuts next year. So completely different situation, right? Dollar is extremely weak, pulled back significantly in the past 12 months. So we're starting the new year in a different camps. So there are 2 things can happen, right? When Fed, usually when Fed lowers interest rate in the next 12 months, you can have this concept of soft landing, right? That the unemployment will stay low, right? Below 4.1, 4.2, I think Fed is projecting. So unemployment is going to stay low, and because interest rates are going to start going lower, the revenue of S&P 500 companies will reaccelerate, right? And nothing is going to break in the system, right? We're not going to have another, Lehman moment or another, Silicon Valley, bank going under, right? So that's scenario number one. And a lot of people projecting basically in the next 6 months, 10 to 15% rally move in the market. Similar to 95, right? A lot of people are comparing to macroeconomic, economists comparing the situation similar to 1995. Nothing breaks, everything works well, and the rapid rise in interest rates and inverted yield curve did not cause any recession. And the market up. Again, there's not a lot of data points. You can't really say that, okay, I'm going to make my decision on 2 data points. It's just not enough. But that is the possible outcome. The second scenario in the next 6 months, we have, this is a breakout of all-time high. We're basically retesting all-time high in S&P. I mean, I did this webinar yesterday. A lot of people said, so the scenario one, scenario number two, in the next 6 months, we're just stuck in this range between 460 and 480. It's a very narrow range, right? I doubt we can be stuck for, we could be here for next couple of weeks. We could be here even, I guess, for next couple of months. But at some point between now and June, we will break out significantly either to the upside to 480, or we're going to break below 460 and, at least revisit October lows, right? So 10 to 15% lower. That's kind of the next move to the downside, right? So those are the, I would say, 3 scenarios, right, that you need to be prepared for. And January, February, usually volatile months, right? Usually the saying is, from seasonality point of view, where January is going to end up, right? January, first couple of weeks of February is where the rest of the year is going to be, right? Because we're going to have earnings of Q4, and we will see whether they're better than expected, and revenues, are we growing at, upper single digits and lower double digits, or are we growing in lower, single digits or, negative, right? Q4 projection that Q4 GDP is around 2%. So if that projection is accurate, then in theory, Q4 should be, earnings should be better than expected, or at least, showing that revenue has been reaccelerating. So those are the 3 scenarios. Why do you need to go through these exercises? I go through them in live trading room on a daily basis, because you need to, if you're a medium-term trader or a long-term trader or an investor, right? It's important to determine how much cash do you want to have, right? Because if the market is going to pull back 10 to 15%, maybe you should have 50% of your portfolio in cash. If you think market is going to rally 10 to 15%, well, maybe only 20% of your portfolio should be in cash, right? So it's a pretty big decision for long-term investors, and and for tactical, short-term, medium, long-term trader, you do need to have a concept of stop losses, and you need to have a concept of how much money are you willing to risk per trade, right, per position. And only this exercise can determine how much money do you want to risk, right? If you don't invest, if you don't think about positive, negative scenarios, then the problem is that you might be, if there is a 10 to 15% pullback like we had in October or like we had in March, you might lose more, your drawdown might be more than 20%, right? You want to avoid situation where your drawdown is more than 20%. That's just kind of a general rule for any money manager, any trader, any investor, right? If you're down more than 20%, and we've been through this situation many times, right? I've been through these situations. I assume everybody on this broadcast either has been or just hasn't been traded long enough. You want to avoid this situation. The only way to avoid this situation is to determine position size and number of positions, right? So that is a very important exercise, right? The goal is risk management, right? To be disciplined, long-term successful trader, it's all about how you manage risk, right? How do you manage risk in your portfolio? If you don't have any, if you don't think about risk, or you don't have any tools for risk management, then eventually you will get caught in large drawdowns like we had in 22, let's say, right? Where you have 20, 25% pullback. Okay, so let's go to this exercise. One, probably one of the most well-accepted scenarios, right? That we're going to have a 1995, the idea of soft landing, right? We talked about soft landing for the past, 24 months, right? In various degrees. So, right, the inflation is not coming back; it's slowly subsiding to the target 2%. Fed continued to lower interest rates starting in March. Unemployment is low. There are no signs of recession, and 10 to 15% rally. Scenario 2, we're stuck here for 6 months. I don't think it's very plausible. I mean, for the next couple of weeks, maybe. Even I would assume even the next 6 to 8 weeks we could be here, 460, 480, but not too long, right? I mean, we had this situation where we're trading in narrow range, but usually there is some kind of a move up or down. If we do break below 460, right, below July highs, then there could be more significant pullback, right? Some kind of a surprise, and then scenario 3. So how many of you say 1? How many of you say 2? How many of you say 3? Let's go over these numbers. Andrei, BJ, Chuck, Dan. We have multiple Dans, multiple Andres, Joseph, Kevin, John, Martin, Michael, Neil, Peters, Rick, Rob, Steven, Sonny. Sorry if I mispronounced the name. All right, so we have 3, multiple 3s. We have multiple 1s. We do have 2. Okay, multiple 1s, multiple. Okay, so it's good. Okay, so actually interesting. Yesterday everybody said 1. I don't think there's anybody said 3. Today half people said 1, half people said 3. Reality, right? Nobody knows, right? Nobody knows, right? You can have an opinion based, but it's still a debate. I mean, majority of people do think 1. I think 3. And again, you look at the probabilities. So for now, my thought process is kind of what the 2 says. Right now, we're trading between 480 and 460, right? We're knocking on the doors of all-time high. You can see in the past 3 weeks, we really didn't go anywhere, right? We didn't really go anywhere. We have another leg up, broke through 460, which is fine. A lot of it fear of missing out. A lot of it is seasonality, right? Winter dressing. A lot of people did not invest in Magnificent 7, so they underperformed. So there is a lot of catch-up game. And then in January, February, market is priced for perfection. Sentiment is at all-time high, right? There's a lot of euphoria. This is a setup is similar to 23, right? The 23, the setup was everything was gloomy and negative. It was a perfect setup for any positive news, and you have this significant rally. And positive news eventually did come. Here it's kind of the opposite, right? The sentiment is at all-time high. We're priced for perfection. Any negative news, right? And the market will sell off. I don't know what the negative news. It could be that the Fed will say, you guys are a little bit ahead of yourself. Nobody's lowering interest rates the first half, right? Based on the macroeconomic data. And then you will pull back. You could have geopolitical instability, Middle East, Taiwan, Russia, Ukraine, that could escalate, de-escalate. That's always the risk, right? You have geopolitical issue. I mean, we have elections year. Usually it's volatile. And then you have earnings, right? Everybody assumes that earnings we will start growing in upper single digit, lower double digit revenue growth, right? If Apple comes out and Microsoft comes out, that listen, we're not growing. Actually, we're cutting people, and that could be an issue, right? We have these earnings from FedEx, from Nike that recently that does show that it's not all Adobe, Oracle. There are a lot of companies that came out and say the projections for 24 is a little bit worse than majority of the people anticipated. So I'm positioning for 3. If you can, I'm still bullish. I have 1 hedge right now, right? 1 hedge right now. So I'm not as bearish as I was in July and June, but I'm kind of preparing. My strategy is to close the winners, trim the long positions, and start hedging the remaining of the long position because the momentum is deteriorating, right? The momentum is deteriorating. Any questions? So that would be 3. What are the main indicators to watch? I still think top to bottom approach will work better than bottom up approach. A lot of it depends on yield, right? Yield significantly drop and it's not rebounding, right? So that's a very bullish argument that even though we have 2 standard deviation move and precipitous drop in yield, there's really no rebound in yield. There is really no rebound in the dollar. Continues to go down, but 2, 3 standard deviation moves that don't happen. Well, recently it happened a few times, but still extremely oversold. So I would keep an eye on 10-year yield and on the dollar, right? As long as they continue to go lower, there is no pullback, right? The pullback is not going to happen. If you do see, based on macroeconomic data, that the yield starts rebounding, then the rally would be kind of in jeopardy. So I would look at the 10-year, I would look at the dollar and small caps, right? The whole premise of the bulls, right? The only way the market rally can continue break through the 480 if the laggards will start participating, broadening of the market rally. Small caps, mid caps will join the large caps, right? So for me, the line in the sand is around 187 on IWM, right? If IWM continues to reverse, looks like we might actually close to the downside this week. It's a little bit red. So we'll see, right? If it's red this week, if it's red next week, and it's red a week after that, then and we drop below 197, then there's jeopardy. Then the rally is in jeopardy. So that's what I would look at some of the indicators. You can look at where we've been watching MMFI, right? How many companies are above, this is what 50-day moving average, right? We're at the extremes, right? We're higher than we were in 2023, January 2023, higher than August 22, almost probably even higher than, well, definitely higher than end of 21. Retesting 2022, right? January 2020 level, right? So it's an extreme overbought situations, right? So if you see, one day doesn't set the trend, but if you see, you have a couple of days in a row where IWM continues to pull back, then I think I would be more cautious, right? Would be more cautious. Okay. Which index this year is Nasdaq of 54%, right? So very good question. So the question is, if we do have scenario number 1, which index is likely to do better in 2024, right? The consensus, I think, if you ask majority of the people, it's the risk on trade. So it's IWM will outperform mid cap, and mid cap will outperform large cap, right? So IWM should be the outperformer, right? And ARC is going to do really well, right? ARC Innovation, high beta, high risk names, right? The theme will be risk on. The last year there is a Magnificent Seven because they produced positive cash flow. Their revenue didn't really drop, and they were in much better position to withstand high interest rate environment. The next year, the theme is completely different. So if there is a soft landing and interest rates are going to drop, then you're going to have a catch-up trade in ARC Innovation, IWM, Bitcoin, right? This will be the year of Bitcoin, of all the popular themes, right? Meme stocks will do well, right? Because people just, the fear of missing out is going to take over, and people just going to seek, high return stocks. assuming soft landing. Assuming, if there is no soft landing and we do have very, some kind of a mild recession, then you have defensive names, usually high dividend paying stocks, usually outperforming, right? So healthcare stocks, consumer staples, utilities, the laggards of this year will do better in the recessionary environment, especially as interest rates drop. So that would be the theme, right? So, that's why personally I'm watching very carefully small cap stocks, right? I mean, one red candlestick is not a big deal, but if you have something like this, right? If you have something like that, then that would be a problem, right? That's kind of what I'm looking for. Where 3 weeks in a row we're making lower lows, lower highs, that would be a sign that the rally is on pause. Until we have that, I mean, these pullbacks, it could be just rebalancing, right? People taking profits, people taking, stuff like that. Not much movement in interest rates, not much movement in dollars. So ARK down 3, IWM down 1, QQQ 0.5%, spiders 30 basis points. I mean, it's just people are probably positioning for the end of the year. Any other questions? Cash secure puts, monthly expiration check. I do like Amazon, right? You want to invest in stocks that broke through the overhead resistance and continue to grind higher, right? So if you're doing cash secure put on Amazon, 1 month away, let's see how much. Well, a lot of it has to do with how much premium you want to collect, right? So let's look at trade here. Amazon, I would go 1 month, so I would go to January, right? January 19. When is the earnings, right? 34 days, so we still have time. So January 2, there's only 3 weeks, so you have to probably go, what did you say, 30 days, monthly expiration. So January 19, probably not enough time. So I would go to February 16, right? I would go to February 16. And to me, the line in the sand is, well, this breakout. 148, let's see, 145. How much can you get for 145 put? So 145 put, you can get $3.70, 2%, right? 2%, it's more, almost 2.5%. I think that would be good, right? To hold position for months and a half, and potentially collect 2.5% would be a good strategy. So on Amazon, I would sell 145 put. I think there will be corrections, so I would spend at least $1 on the long put, right, and buy 130 put. This way, at least if we do have these big pullbacks, you don't have to worry about. I mean, you still have to worry because it's a $15 difference, but that would be my approach, right? This way, you can collect close to 2%. If you can collect 2% every 2 months, multiplied by 6, that's 12%, right? And you're reducing your cost basis. So that would be my strategy. I mean, obviously, if you want more premium, then you have to come closer. Then you would have to sell 150 put. But for $2 more, taking $5 risk, I personally I wouldn't do it. So that would be Amazon. Google also broke through overhead resistance, right? I'm looking at the weekly chart. It broke through the overhead resistance. The line in the sand is 130, right? The line in the sand 130. I would not, if we drop below 130, then this rally is in trouble, right? I would say 126 actually. That's been kind of a long-term support. So let's look at 125 or 130 on Google. And again, you're taking the risk of earnings, right? Because if you do in January 3 weeks, you might not get enough, right? If you look at Amazon, the reason you're getting a lot of premium is because you have to take the risk of earnings, right? And Amazon could be up 10%, could be down 10% on earnings. So if you do in January 19, 145, same 145 put, it only pays you 80 cents, right? You're not even getting 1% for January. So it almost doesn't make sense to take the risk for less than 1%. So January, I wouldn't do it, right? If you trade 150, it's too close, right? So I would go to February, but February you have to take the risk, right? That Google might drop 10%. So as long as you are comfortable, or Amazon, as long as you're comfortable with that, the risk, then it's fine, right? And then Google, same kind of approach. If you do January 19, right, and you want to look at the support, which is around, last week 130, right, 130. I assume same thing. Google, you're not gonna get much premium. January 19, 130 put probably will be less than 1%. Right? There's just a couple of weeks left. Yeah, you're not getting any money. To get even 1%, you have to trade 136. 136 we could be at 136 on January 2nd. So I would not do it January. I would go to February. If you're looking for monthly expiration, that makes more sense. And then 130. What did we say? What did I say? 130. 130. So for 130 January, 130 put, okay, $2, right? So you're getting a little bit less than 2%. A little bit less than 2%. So I would, which is fine. I would sell 130 put, and I would hedge it maybe with 115 put. So you have at least, if there's a sudden pullback. So that would be my approach, right? If you can collect 2%, 1.5%, every month or 2 months, that would be my approach, John. For cash secured puts, right? But I would still, some people do believe that if we do have any signs of recession, or the Fed is not lowering interest rates in March, you're not going to have a mild pullbacks. You're going to have a steep corrections, right? Because people just don't anticipate that, right? And there's just too much built into current stock price. Just like last year on the opposite side, right? We had a pretty strong rally because everybody was so negative that any positive news and you have a strong rally. It's a similar setup. If everything is great, it's going to grind a little higher. But if any bad news, then you're going to have sharp pullbacks. Any other questions? All right. So what do we do at Tradespoon to help you kind of with different trade ideas and themes? We're basically dividing the services in 2 categories. One is where you can follow my trades. Right? If you want to know what I trade and when I traded, then you follow one of my Vlad's portfolios. It's a robo-investor, stock only, premium option spreads, elite circle, everything. So usually if you're new to trading, I would recommend elite circle, or if you're experienced trader but you just want to know when I trade, which is also a lot of people do that, then I would look at elite circle. So let's say yesterday I trimmed General Electric position, right? I closed AT&T position, and I closed Qualcomm position, right? So there are a lot of stock positions, and you will know exactly when I enter them and when I exit them. In the last 7 days, you can put your phone number in SMS alerts. You just click on this button, enter your phone number. That will register with SMS, and you will get SMS messages. Plus, you can participate in morning bell and closing bell, right? You can actually watch the recordings. I think the best value on Tradespoon is elite circle, because you can build your trading plan or enhance your trading plan if you don't have one, or if you have one, you can enhance it. If you don't have one, you can build one, and you can participate live, or if you're busy, you have other commitments, during the morning bell, first hour and last hour of trading session, then you can watch the recordings, right? I think that's the best value. And I will accept the challenge. Anybody who wants to try it for 3 months and watch the recordings or participate live for the 3 months, keep a journal like I recommend in live trading room, grade yourself, and don't risk that 2.5% that I recommend. As long as you're able to do the challenge is if you do it for the next 3 months, your performance, I think, is going to significantly improve before and after, right? Whether you experienced trader or someone is new, right? So that would be my challenge to you. Getting text messages on its own, I don't think is enough, unless you're an experienced trader and you have a trading plan. You know when to get in, when you get out, then you don't need to be in live trading room. Then I get it. A lot of people don't come to live trading room, but if you're somebody new or you still don't trust the process, this is almost a requirement. Either watch live or watch the recordings. So I would start with a lead circle, right? And combination of both, because we have option traders, we have stock traders. So you can see I'm trading General Electric, Qualcomm, AT&T, liquid S&P 500 stocks. Looking for, Qualcomm was, I think, 1% gain, right? Bought at 145.3, closed 146.4, so a little less than 1%. So looking for short-term trade, I look 0.5% to 1%. If I hold it for a couple of weeks, it could be 2%. If I hold it for a couple of months, it could be, I have IWM, then, it's more than 5% gain. And then I do have and options. So sometimes I go long. This example, I'm hedging my long position with February, QQQ put spread because I think, the market is vulnerable for pullbacks. Questions? So I do stock trade. You see the stock, and I do option spreads, right? I do also try to do cash secured puts, right? That's why I always say, if you have $10,000 account, maybe a selling 420 put is not appropriate for your account, right? You need to find maybe XLK or do Google, which trades at $100. But strike price selection is extremely important. I do believe in cash secured put and calls. It's just instead of doing, short, I'll still do a spread. It's just maybe wider strikes. I do cover calls. I do iron condors. Those are for earnings season. So those are most common strategies. Option spread, 4-legged strategies, 2-legged strategies. I don't do butterflies that much. I don't do, collars, but merit puts, merit calls, this is something that you will see often. Thank you. All right. So that's the lead circle, right? So you can see all my trades, right? Real time, and you can participate in the recordings. If you have a trading plan, right, and you've been trading long enough, we do have a lot of tools, right, that can help you enhance your performance, right? Stock forecast toolbox has been very popular, especially with people that have experience trading, because it shows you, any trader, you need to see direction, right? Spiders is slight uptrend, not a lot. You can see it's deteriorating. 475, 477 is your support and resistance, right? Very narrow range, right? Very narrow range. If you zoom out and look at 6 months, prediction basically says 470, market is overbought, right? And long-term trend is neutral. You don't see we used to have a very strong bull trend right up until October, but with the sell-off in August and September and October, the trend has changed actually to neutral, right? The market is extremely overbought, and you're not going to see a lot of momentum above 485. That's what the model tells you. But there is a possibility in the next few months we're going to revisit 423 level, right? So this is without any judgment or biases over soft landing or recession. This is just purely on the price action that has been happening in the past, 6 months. So, is it always right? No, but 70% of the time it is right, and unless we're going to have some kind of a generative AI surprise based on purely price action, right? Purely on price action, that would be my guidance for the next few months, right? That can we get from 478? Sure. Can we get to 485? Yes. I mean, can we get to 490? Fine. But that's not a lot of room to the upside, right? You're squeezing kind of these returns. But any negative news, and you're back to 420. So that's stock forecast toolbox. Some people misunderstand the intention. The intention is to show you the trend based on the time and trigger points, support and resistance, right? A lot of people would look at this and say, Vlad, this model is not good. You predicted 470 back on December 1st, right? Once a month, and we're at 476. The only way I usually reply to this is, I don't reply it like that, but the truth of the matter is you just don't have reasonable expectations for what models can and cannot do, right? These are neural networks. They learn, they train, they look at the input data. But if there's generative AI, and or if there's a war in Taiwan, the model can predict this, right? And it's almost impossible to predict what's going to happen in 30 days. So if there's an attempt to show you the range, and we are staying very close to the range within 1%, I would give this model an A, right? It's doing a really good job in the months of December, like phenomenal job, right? So that would be my reply, right? So, but some people think that, if it says 470 and 476, well, that's a problem, right? Because I started shorted the market at 470 and I lost money. It's at 476. Well, my reply is, please join live trading room, ask questions, and then I can tell you what you can and cannot rely on, right? So that's the most common mistake, I would say. The other one is, it's a neutral trend, but let's say we have 10% up after earnings, right? Earnings are going to be phenomenal, and Fed will announce that, we will lower interest rates in March. Model doesn't know about that, right? It has no idea. So if there is any input into the data that's, kind of geopolitical or macroeconomic, that's a surprise, well, then the model has to adjust. And it's not our model, it's any model, any predictive analytics, right? I think our predictive analytics are, a lot better than average model you will find out there. So that's stock forecast toolbox. I really enjoy working with this model. We constantly enhance it and improve, build new models. Seasonal chart, not the best tool on its own, but has been very accurate since August. And you can see correlation is back to 83%. So since August, we've been very highly correlated. And you can look at silver, you can oil, they all have seasonality, right? All the major asset classes have certain seasonalities, right? So we have seasonal chart that people enjoy, and you can enter any stock or ETF to research. And then to help you trade, we have active, different models giving you different output for different time frame, right? Active trader meant to be short-term trades, right? You can go every day and it'll tell you, today JP Morgan, right? Today JP Morgan, consider going long on JP Morgan, right? If it hits 170.30, then okay, like it is now, that's a good entry point, right? And you can substitute either doing stocks or you can do options, right? And gives you two choices. You can buy stock or buy an option. And I do believe in dollar cost average, right? So Participate in live trading room, ask question how to use this model, like Qualcomm trade, GE trade. This is all from either active trader or weekly trader or monthly trader, right? Depends on how long you want to hold a position, right? AXP, American Express, was this week. So those are different models. Basically, gives you signals, but then you have to manage them, right? A lot of people start asking me question, Vlad, you said 167.87, it never hit 167. Or what if the gap up? Or what if it gaps down? How long do I wait? My answer is please, please, please sign up for a live trading room, watch the recordings, trade with me for a couple of weeks, and then you will get all these answers, right? Because it's not, the expectations that model can predict exact entry point. Market can give you suggested trigger points, support and resistance, but if these support resistance don't get reached, you have to make a decision based on other parameters, right? Your experience, you can look at RSI, MACD, chart patterns, whatever your decision process is. But if you don't know the answer to these questions, then please, please, please sign up for Elite. Join live trading room, and it will help you become a better and more successful trader. All right, so that's active trader, weekly trader, monthly trader. If you just want spreads, then you have spread trader. If you just want to follow my trades, that's shadow trader. But those are the main paid subscriptions. We do have a lot of educational content, market newsletter. Once a week you get a newsletter, you get all the recordings, even the live trading room. We do have a YouTube channel. If you're still not sure whether this is something right for you, join our YouTube channel, click on subscribe, find the word Tradespoon on YouTube, click on subscribe, like our videos, and every Wednesday you can participate in live trading room, right? You ask questions and I'll help you with any questions you might have. Yes, Chuck, monthly, weekly included in Elite service. Yes, they are. All right, any questions? I do tend to go quickly and cover any questions. Okay, so in terms of themes, again, I would look kind of what Chuck said, I would look at Amazon. To have some kind of an anchor point, right? From psychology point of view, it's still a trader's market. I mean, we just recover all of the losses in the past 2 years, and majority of stocks that are high beta stocks are still trading almost in the bear territory. So if you're trading in this market environment, you have to have what I call trigger point, or not anchor point or reference point, because I went at length to go over prospect theory, right? I've been influenced by this book, Thinking Fast, Thinking Slow, right? And actually got the guy got Nobel Prize, right? Tversky and Kahneman, they got Nobel Prize for this research. Behavioral economics, right? It's a very important topic, right? If you haven't heard about it or haven't used it, I encourage you to read it and understand this, right? But it shows you this kind of classical example, right? If you have $450 gain, 100% chance, right now you're up $450, and you have a chance, right, to take $450, or take 50-50 chance that in the next couple of months, the market is going to rally 5 to 10%. You're going to make $1,000, right? Most market participants that don't, just start trading or don't have a lot of experience, they will take 100% chance, right? They'll say, Vlad, I'm up $450. Nobody knows whether the market is going to continue to rally. I'm out. Now, the other scenario. Back in October, when everything sold off, or September, there were positions where you're down, same thing, $450, $500, right? You have a 100% chance to take the loss, and or 50-50 chance, right, that market is going to recover, right, and you're not going to take that loss, or 50% chance that it will continue to sell off and you will lose $1,000. right? You already know the answer that majority of the people will do 50-50 chance. So on the upside, we take 100% chance and cutting our gain. And on the downside, most of the time we are waiting. So very quickly you realize that one losing trade will cover 2 winning trades, right? So even with 75% accuracy, which is very extreme, your best case scenario, you thread in the water, right? Because you have 1 losing trade that covers 2 winning trades. So this risk aversion that our relationship with losses is different than our relationship with gains, it's kind of the foundation of trading, right? So if you don't understand prospect theory, you don't understand foundation, then I encourage you to participate in live trading room, or at least do this research on prospect theory, kind of analyze your own risk aversion and how do you deal with money and gains and losses, right? There's this, usually it's a utility theory that, we treat everything the same way, but the utility theory, which actually was the predominant theory even, more than 20 years ago, this is relatively recent, kind of shows you how we are operating on our biases, right? And our cognitive biases. So, right, prospect theory challenges the expected utility. Expected utility theory, you always do the same way. So only experienced traders use utility theory, right? You want to approach them with the utility theory that these outcomes are treated equally. The only way to do it is to find the reference point, right? So how do you find the reference point? For Amazon, we broke through August of 22, we broke through August of 23, very well defined level, right? Let's move that line maybe even here so everybody can see it. Okay, as long as we're above this line, I'm a bull, right? We drop below this line, I would, then. So you have little room to the downside, but if the market continues to rally, Amazon is going to be $190 stock. $40, it's 20-30% return. That's pretty good, right? For little risk, you can potentially gain, right? IWM is in that category, right? As long as it's above this line, right? Well, I'm bullish on the market. We drop below this line, then I'm less bullish. So on the downside, I have maybe 2 to 3%. On the upside, if the bulls are right, we could have 20% rally, right? A catch-up trade could be another 40 points. So that would be my approach to trading right now, right? You don't have to be bull, you don't have to be bear, but you find stocks with clearly defined entry and exit points, especially if it's a medium term or long term support and resistance. For day trading would be the same thing. So IWM, Amazon, ARC Innovation, right? These are the good investments because you have a clearly defined target gain and stop losses, and you have little room to the downside, but you have a lot of room to the upside, right? If something did not break, like Roku, right? We talked about Roku, right? It broke above the trend line, right? It broke, kind of long-term base, broke above this base back to May of 22, but now it pulled back and trading below that. Well, that's not a good setup, right? There's little room to the upside, right? I mean, can it revisit 105? Sure. But you know what? It can, if it doesn't have a good earnings, it can revisit 55, right? So there is more room to the downside than to the upside. So I would look for these kind of chart patterns. General Electric has similar price pattern, right? You have clearly defined trigger point. Boeing has a similar setup, right? You have a clearly defined trigger point, right? If it drops below 242, I wouldn't be very bullish on Boeing, but if it jumps above 280, then yeah, it can go to at least pre-pandemic level, 350, right? So there's a lot of room to the upside on some of these names. So that would be my approach to taking these trades. All right, any questions? Chuck, yeah, you can use Delta. Yeah, so usually Delta 30, right? So let's look at where's Delta. Yeah, so you see I was right, Delta 30. So usually when you sell these puts on cash secure put, you want Delta to be around 30, right? 140, 44%, that's 50-50, right? 70% chance, okay, that's better, right? So delta 30 is usually a good indication for cash secured put. Or options shred, when you sell premium, usually it's a delta 30, right? If you want to do out of the money, you ask 9 out of 10 people will give you 30%. I actually look at support and resistance too. So for me, it's a combination, right? To me, support resistance is more important. It's just, sometimes I don't get enough premium. If I get 2% premium and I hold position for months and a half, I think that's a good deal. If it's delta 30 and I'm getting, less than 1%, well, I mean, that's not good. Michael, my thoughts on FSR. Haven't traded FSR. Fisker, I mean, I'm biased, right? I have a friend who bought Fisker and he can't get a repair, right? So from chart perspective, it looks horrible. From the quality of the product, I mean, it looks great. It does look great. It's very pretty, but there will be winners at the end, and there will be losers, right? In the electrical vehicles, but some companies, will go under. Like I forgot what there was an electrical company bankrupt. What was the name of it? Electrical company bankruptcies. What was it? Who's Tesla rival? Lordon's, right? Okay. So there'll be Lordstown Motors, right, of the world, and there will be Teslas of the world. So Fisker chart looks bad, the story looks bad, unless you have something else. Yeah, it's up 14%, but I mean, in the scheme of things, if you look at the weekly chart, it's I don't know what the news today, but I would stay away from Fisker, until it builds this multi-month support and at least jumps above 4.5. I would stay away. Rivian, I like it. I see it in every corner. I think it'll be here. It's not going to go through bankruptcy, right? So at least Rivian looks like longer-term base, right? This kind of cup and handle. I mean, it needs to clear this level before you get too excited about Rivian, but it's stable, right? So Rivian, Teslas of the world will be, Lucid. I don't know if they're going to be here. So yeah, I would stay away, at least for now. Right, these companies, have a very large burden of cash flow, right, and debt. And for now, nobody's lowering interest rates. So there are every monthly payment, every quarterly payment. The question is, can they avoid bankruptcy? And some of them will be able to, some of them will not be able to. Mark, today's action profit taking or structural? Usually I don't try to call the top or I try to call the bottom, right? Usually I don't do that. So I propose to look for top building process, right? So spiders, I mean, we've had this day, right? We had 1 or 2 days where the market is down. That doesn't set the trend. So there's nothing structurally, I propose to wait. 460 is your line in the sand, right? If we drop below, I mean, first we need to drop below 467. Once we drop below 467, that's your first kind of warning sign that most likely we have built the top, right? If we drop below 467, right, then whatever that level is at the top, then we have set the top. Right, the market is probably not going to go above 480. Can you say that today? No, you don't have enough data. But if we drop below 467, I would say the top is set at 477. If we drop below 460, then the trend, the medium term trend has been reversed. And you should expect more room to the downside. How much more room depends on the news. But for now, one day, this is just a sign that the market is overbought. There's no news today, right? Do we have any news today? Did I overslept today? Friday. Chicago business. I mean, I don't think this is anything that can. So today, just people taking profits, right? Taking profits. A lot of people made a lot of money on Magnificent Seven. You know, it's the last day to take profit. You have you have expiration, right? Quarterly expirations, end of the quarter rebalancing, end of the year rebalancing, right? You don't have any expiration, but except weekly, but you have quarterly, end of the year rebalancing. So can you take a lot of, signs from that? No. But, like just same as here. But if you have kind of in August, right, you have 1 day down, 2 day down, 3 day down, right? Then the top is probably set, right? And then once you break some key support, like here in 442, then you know this downward momentum is going to continue, right? So that would be my approach, right? Look for top building process, especially if there's no movement in yield. Market is going to be moved by yield. If yield doesn't move and dollar doesn't move, then this is just daily price fluctuations. I mean, we haven't had a 2% down day for a long time, so 0.5% is expected. Any questions? All right, guys, that's all I have for today. Thank you very much for your participation. Really appreciate your time commitment. Take me on for the challenge, sign up for Elite, participate for the next 3 months. And I'm going to make a bold assumption that your monthly fee is going to be covered and more. So otherwise, Happy New Year, best wishes, happy, healthy, prosperous 2024. Hopefully all the wars will end, and I will see you. Well, there is still closing bell today, so either closing bell today or I will see you. Actually, I'm off next week. I will cover some of the morning bells, so I will see you next week. Thank you very much. Chuck, on Yellowtown, we do have a dynamic power trader or Elite. Similar platinum. We have a platinum power trader. Joseph, thoughts on gold. So thoughts on gold and silver, right? I forgot about gold and silver. Thank you for reminding me. So that would be a bear argument, right? So it's not all clear signs. So in 1995, we went through this chart. Gold went down, right? Gold, after Fed started lowering interest rates, gold significantly pulled back, market significantly rallied. If we cannot have gold at all-time high and equity at all-time high. Something has to give, right? Usually. So most of the time, gold is perceived as flight to safety. So gold is at all-time high. If gold is going to break out from all-time high, I doubt that equity is going to break down. They're going to go in a different direction. So I would watch the price of the gold. Since I'm bearish on the market, I'm bullish on the gold. And I think it's just a matter of time for gold to break out. It could be tomorrow, it could be January, February, March. I'm not going to play these guessing games, but I think Q1 or Q2 gold will break out, i.e. equity will pull back. BJ, yes. So that's answer your questions. Yeah, Swiss franc, right? Swiss is going higher, and yen is going higher, right? Those are the still, it's very hard to reconcile, right? So usually when yen goes up and Swiss franc goes up and gold goes up, that's a problem, right? It's a problem for bulls. So I would keep an eye on these asset classes. Black Swan events, for sure, Kevin. Black Swan events, you don't want to miss that. BJ, Happy New Year. Peter, thank you. Happy New Year. Joseph, Happy New Year. All right, guys, get ready for celebration. Hopefully everybody's going to have a great New Year, and I will see you soon. Thank you very much. Take care.